What's our first company? Take-Two?
Yeah, our first company is Take-Two Interactive. The ticker symbol is TTWO. We're going to get after it using our 8-pillar analysis of stocks and companies to see how their financial health is doing. Pillar number 1, Paul, is as always, PE ratio. We want this under 20, baby.
Well, first off, market cap.
Oh, sorry about that. Look at me. I'm jumping ahead. I'm so excited.
$22.9 billion. The PE right now is 48, so that's an X. But they do have, like software businesses should, a very good profit margin, 14.1%. So we're starting off with an X and a check. High PE, again, it's not a no automatically. There could be some, like remember the Walgreens, they had like a 70 PE, then we looked at the data, we're like, wait, it's not really a 70 PE. That's how you look at cash flow. But so far, 1 check and 1 X.
Pillar number 3 is revenue growth over the past 5 years. To hell with Elmo. Let's go back down to Take-Two.
I want everybody to see something about our website. If you check out here, we have annual data, quarterly data, trailing 12 months, and also 4 quarters. What I prefer the 4 quarters because now it's going to lump the last 4 quarters of data, whether it was the end of the year or not, together. The next 4 quarters together, so we can look at it more because if you guys remember, some of the times we were doing the data, we were looking at end of 2019. I don't want to look at the end of 2019. I want to look at the most recent data from the most recent quarter we have. So, revenue, 1.52, 3.36, check mark.
Wow,
massive jump, and something tells me in this area somewhere there was an acquisition of some sort. So we do have a check mark there.
I would assume pillar number 4, profit, is also up, Paul, wouldn't you think?
Well, from 1.85 million to 475, yeah, that's a check mark too.
Wow, geez Louise, look at that. Okay. How about shares outstanding? What would you think a company like this is doing, Paul?
Exactly what they've done. This is bad. 337 million shares to 455. Ooh, that's rough. So they've increased their number of shares by about 30%. Or almost 40%. That's pretty bad.
Don't you say often, Paul, that the higher ups of these companies, they sort of, by selling off more shares, they're sort of admitting that their price is probably overvalued and they can make some money on it?
Think about it. If you were a CEO of a company and you have a massively overpriced shares, you'd want to issue more shares to get that cash because now you're issuing shares at a really high value as opposed to a really low value. So that's an incentive for them to go issue more shares. As you've seen, I don't think Amazon has decreasing shares. I don't think Tesla definitely doesn't. So either way, balance sheet, guys. We have total cash, $3.93 billion. Total liabilities, $2.33. Here's the deal. Total liabilities, $2.93. So they have over $1 billion in extra cash on hand than total liabilities. So this is the mother of all check marks. We have a check mark for it, but you have to subtract $1 billion from the market cap because if you bought the company today, there's enough cash on hand to pay all the debts off and have $1 billion left over for your pocket.
Incredible. Pillar number 7, Paul. We're already up to pillar number 7, which is free cash flow growth. I'm getting my calculator ready, so I'm prepared for the calculation. Go ahead.
Good boy. So we have 289 million to $1 billion, basically.
Oh Lord. Okay, that's
check.
That's a check. Okay.
329. 585 and 835.
Good Lord, Paul. Divided by 5. The average free cash flow is 600, but the last 3 years have been baller, Paul.
Yeah. I'm going to go ahead and veto the 600. I'm going to focus on the last 3 years. The last 3 years, the average is about 800 million, roughly. 750 million. Call it 800. Now, times. This is a fast-growing company as it appears to be. I don't know if it is or not. Our PE, we want less than 20.
Let me slow you down. As I'm formulating this and learning from you, Paul, as is a company that's growing this fast, we can use...
Free cash flow is growing fast.
Yeah, for price to free cash flow, we can use a higher multiple, higher than 20, wouldn't you think?
Yeah, but I think 20 is fine for this because I just remembered now the revenue growth is not a lot. The free cash flow growth is a lot, but the revenue growth is not a lot. So I still think sticking at 20, we're at $16 billion in value. It's currently at 22 minus the 1 billion that you're getting. So it's currently at $21 billion. So it needs to still drop by about 30%. So I like what's going on the free cash flow side. I love the balance sheet, the fact they have plenty of cash to pay off all their debts. I don't like the PE, but we can tell the PE was 48. It's a little messed up right now in the sense of there's some write-offs in there because the free cash flow number is very solid. I think we're okay at paying the PE. If we just went off PE, we want the price to fall 70%. But based on the free cash flow, we only need the price to fall 30%.
Paul, let's head over to Trader Mode to see what kind of momentum we have going on this.
Okay.
right now, and starting Tuesday, we started to move into a downtrend. Our red stochastic line, trend line, broke right under 80% perfectly, which is initiating a perfect short. Now, there is going to be a lot of resistance right along here, and that's the 192 area, maybe a little bit above it. So what I want to see is some good volume, and I really need to see some good red candlesticks breaking through to make sure that we can get through this resistance point. You can see, dating back to mid-December, it has had a very difficult time coming through there. It tried to drop down once, came back up, tried to drop down again, and here we are for the third time. So we really need some selling volume in there to push this thing down. If you want to trade this, put a tracker share on there and roll with it from there.
Share?
One share. Buy one share, and it just keeps it in your portfolio so you don't forget about it and miss it.
So let me ask you a question. Are you shorting right now, and then if it bounced off of 192, exiting the short, or are you only shorting when it breaks through 192?
I'm going to add shares to my one share when it breaks through 192. But right now I'm only going to have one share on there just to make sure that this, on a short, just to make sure that this thing does get to that level and it doesn't bounce off again and just keep going back up on us.
Yeah, if you're drawn to this, you can join the middle tier of the Patreon and talk to Mo every single day. Paul, you said something to the effect that we need this stock to drop fairly significantly before you're in, but what are the odds this thing doesn't drop? I mean, this is the game we play, right? What are the assumptions you're making? I mean, this looks like it's growing every year, I think nicely.
Yeah, but look at the growth on the revenue side, though. So this is what made me halt a little bit. The revenue growth was only 6 or 7% in the last year. From September of 2019 to September of 2020, it saw very little growth there. Now let me go make sure there was an acquisition that was done here. Oh, we haven't done that yet. That part is not even in there yet. Okay. I just don't like the fact that I see the revenue growth coming. I mean, look in the past here, Seth. Look here. We had drops over here. I mean, there might have been a disposition here, then grow, drop, grow. I mean, so I look at it going, there's still very inconsistent growth. It's not like Microsoft in 2012 and I was sitting there going, listen, this company, literally their revenue grows 8 to 10% a year. I'm believing in this. I just look at it saying, you can buy it right now if you believe that the growth will justify it, and more power to you. The question you have to ask is that, to me, I want to find 20 or 30 investments that are selling for well below the price I want to buy them at. So I want to find companies that I think are worth 16 billion, but I can buy them for 8 billion. Mm-hmm. Now, we're sitting here talking about buying the company for exactly what it's worth. It just all depends on what I'm not saying you don't buy it, but I'm just saying from a standpoint of what I'm looking for as a value investor, I'm looking for a drop.